Hello and welcome to Lecture 2. We'll be covering topics out of Chapter 15 in your book. We'll be discussing specifically how to raise capital, or the different ways in which businesses raise capital. When companies, especially newer companies, need cash in order to pursue positive NPV projects, where do they get that cash? So that will be what we'll be discussing in lecture number 2. Let's start with venture capital. Now, venture capital is private financing. When we say private, that means that this equity that is purchased or sold to venture capitalists is not readily available on the open market. You can't go to your stockbroker and say you want to buy it. So it's private financing for relatively new businesses in exchange for a certain amount of equity. Usually it entails some hands-on guidance. So these will be venture capital firms are professionals who will invest in relatively new businesses and help them with a lot of hands-on guidance so that this investment by the venture capital firm is successful. The company should have an exit strategy. What do we mean by an exit strategy? One strategy is to sell the company. So the VC or venture capital firm will invest, help them grow, and then sell to another company. The venture capitalists will benefit from an increase in value, and they'll sell it for a lot more than what they purchased it for. One of the other primary way to exit strategy is to take the company public, and this is where the stock is sold out to the general public, and the goal would be that the equity would be sold at a much higher valuation than what the venture capitalist invested in. So the VC will benefit from an IPO, an initial public offering. Many VC firms are formed from a group of investors. A consortium is what they'll call it. They'll pool the capital together and then have partners in the firm decide which companies will receive financing. So the venture capital firm will look at all the different opportunities available to them. There are always companies looking for additional capital, and so there's a lot of investment opportunities for venture capital firms. And so they'll make the decisions based on where they think they'll be able to create the most profit. I mean, there are standalone venture capital firms, but a lot of the large corporations will have a VC division that will invest in new ideas and new concepts and new businesses. So if you are the new business looking to grow and you need venture capital, how would you choose your venture capitalist? First, we would look for financial strength. Do they have the money? Can they help us? What if we need more money than what we're initially asking for? Will that be a problem? What if we see additional opportunities as a result of the initial wave of capital coming in? And can our venture capitalist help us with additional capital? Also, we want to choose a VC that has a management style that is compatible with our own. We don't want to constantly be butting heads with the venture capitalist. We want to be partners with them to grow the value of our company so that we can both benefit as we exit. We would want to check references. We'd want to speak to other companies that the venture capitalist has invested in, discuss what their experience was with the venture capitalist. Also, we want to look at what contacts does the VC have. If we know that this venture capitalist has had success in our same industry and knows everybody in the industry, those contacts are extremely valuable, and they'll be able to help create deals that will bring value to our company and increase, again, the valuation of our company. Finally, how successful has the venture capitalist been in the past in exit strategies? Have they successfully been able to sell their portfolio companies to either other companies or help bringing them to market through an IPO? Their past record of success in exit will be another thing that you'll want to look at when choosing a venture capitalist. Moving on, we could sell securities to the public rather than selling to a VC firm. We could sell it to the public. Management has to obtain permission from the board of directors in order to sell securities to the public. And a firm has to first file a registration statement with the SEC. The SEC stands for Security and Exchange Commission, and they oversee all of the sale of securities and investment products in the US. The SEC will examine the registration during a 20-day waiting period. And so the company seeking capital through selling their securities to the public will have a preliminary prospectus. We call this a red herring. So if you hear the term red herring, it's just the prospectus. It's the document that has to go on file and is made available to the public. It's distributed during the waiting period and basically tells about the company and the offering. If there are problems, the company is allowed to amend the registration, and then that 20-day waiting period starts over again. So the securities cannot be sold during the waiting period. It has to be after the waiting period is over. And the price is determined on the effective date of the registration. So when a company is looking to sell securities to the public, they're going to have a target price, but the actual price is not determined until that effective date. The next source of capital that companies can draw from are crowdfunding and ICOs. And we'll talk about crowdfunding first. On April 15th, 2012, the Jobs Act was signed into law. A provision of the act allowed companies to raise money through what we call crowdfunding. And this is a practice of raising small amounts of capital from a large number of people. You've probably heard of crowdfunding before. Kickstarter is a crowdfunding website where entrepreneurs can go and get capital from a large number of people. And crowdfunding is typically done via the internet. There are two different types of funding that we're going to look at. First is project crowdfunding. This is pre-selling products or services to raise enough capital to actually produce the product. I've got a brother-in-law who has invested in many things on Kickstarter. So a lot of the time it's this project crowdfunding where he'll buy the product before it's been produced. And if they raise enough funds through that project crowdfunding, then he receives the product. And if not, then he's had a few that have failed and he doesn't get the money back. And that's just the way investing is. The other is equity crowdfunding, where you're actually selling equity ownership. And he's done a number of those as well through Kickstarter. So that is a great way, especially if you're a very, very early stage entrepreneur and you've got an idea that you want to bring to market. Crowdfunding is a good way. The other is what we call, the next topic we'll cover is called an initial coin offering. And this has to do with things like Bitcoin. These are crypto currency or crypto investments. And in an initial coin offering, you're selling tokens that give holders the right to use a company's service in the future. Next, if you turn in your book to table 15.1, it discusses the methods of issuing new securities. And we won't go through this table in the PowerPoint presentation, but we'll talk about much of the underlying or information within the table. So first off, we want to talk about underwriters. We talked about selling equity to the public markets. Well, how do we do that? What mechanism do we use to get our equity offered and into the hands of investors? Well, This is done typically through underwriters. The services that are provided by underwriters, first, they formulate methods used to issue securities. They price the securities. When I'm talking about securities, I mean equity generally. So they determine what the per share price should be when it's sold to the public. They sell the securities for the firm, and they act in price stabilization. Usually that's done by the lead underwriter. So underwriters, you can have one underwriter that's dealing with you, or it could be a syndicate, which is a group of investment bankers that market the securities and share the risk associated with selling that issue. So when we say lead underwriter, it would be the main investment bank in the syndicate, but there will be other investment banks who will also participate in the initial public offering. The spread, this is an important concept. Spread is the difference between what the syndicate pays the company for their stock and what the security sells for initially in the market. So maybe the company that is raising funds will receive $20 per share for their stock, but maybe the syndicate is selling it for $22 per share. So the spread there is the difference between the 22 and the 20. It's a $2 spread. There's different types or arrangements that underwriters can make with the firm that wants to raise capital. The first we'll discuss is called firm commitment underwriting. In this case, the issuer or the company trying to raise capital by issuing new equity, the issuer sells the entire issue of new equity to the underwriting syndicate. So it's already sold. It's sold in one big chunk to the underwriting syndicate. Okay. And why is it not okay? So the syndicate will then resell the issue to the public. And the underwriter makes money on the spread between the price paid to the issuer and the price received from the investor when the stock is sold. The syndicate is the one that bears the risk, though. In firm commitment underwriting, the company has a guarantee. I mean, they've received their money already from the underwriting syndicate. The syndicate is the one that bears the risk. What if they can't sell the entire issue for more than what it costs them? So that's the risk that they make. This is the most common type of underwriting in the United States because the companies that are trying to raise the capital don't want to take the risk, and they'll place that risk onto the syndicate. The next form of underwriting is what we call best efforts. And in a best efforts underwriting, the underwriter must make their best effort to sell the securities to an agreed upon offering price. And so the company that's issuing securities, the issuer, will agree to an offering price with the underwriter, and then the underwriter will go out and try and sell it for that price. The company in this case bears the risk of the issue not being sold, whereas the underwriter will make their money really regardless of whether or not they're able to sell all of the securities. The offer can actually be pulled if there's not enough interest. So if the underwriter isn't able to find enough people to buy the equity, then they'll cancel the offering, the public offering. In this case, the company does not get the capital, and they've still incurred substantial flotation costs. They've paid the underwriter and gone through a lot of effort and cost. So you can see why best efforts may be less desirable for companies trying to raise capital as opposed to the firm commitment underwriting. This is not as common as it previously was, just because companies are trying to avoid the risk as they raise equity. Okay, the next thing we're going to discuss is Dutch Dutch auction underwriting. This is a different form of underwriting, the most famous of which was the Google IPO. So let's just talk about this a little bit. With Dutch underwriting, the underwriter solicits bids. So the underwriter will accept a series of bids that include, the bid will say the number of shares the bidder is willing to buy at what price. Okay, and so the underwriter will collect all of those, and the price that everyone pays is the highest price that will result in all shares being sold. So it's a very interesting approach, but it ensures the highest possible price in order to sell everything. There's an incentive to bid high to make sure you get in on the auction, but knowing that you'll probably pay a lower price than you bid. So it'll be sold at the lowest or the highest price that will result in all shares being sold. And so there's a chance that the company will receive more than what they would think or want, and there's a chance that they'll receive less. And the Treasury uses Dutch auctions and has done for years, but as I mentioned, Google was the first large Dutch auction IPO, and they did that online themselves. They underwrote it themselves. A couple of other concepts in relation to underwriting and new issue of stock. There's the greenshoe provision, and that allows the syndicate to purchase an additional 15% of the issue from the issuer. So let's say the issuer, the company that's trying to raise funds, wants to sell 100 million shares worth of stock, and the syndicate is able to do that. The greenshoe provision allows them to sell another 15%. And so this allows the issue to be what we call oversubscribed, so that sold more than what they were planning on. It provides some protection for the underwriters as they perform their price stabilization function. So it gives them an opportunity to make a little bit more money on top of what they were already planning, and to stabilize the prices. Then there's lockup agreements, and these are restrictions on insiders. So like the CEO, the CFO, it prevents them from selling their shares in an IPO for a specified period of time. So those who already own shares before the IPO, they cannot sell them for a certain period of time, and that's typically 180 days. So the IPO happens, the original shareholders have to hold on to their shares and just watch the stock price go up and down for 180 days before they can cash out. The stock price tends to drop when the lockup period expires due to the market's anticipation of additional shares being sold, hitting the street, so to speak. IPO pricing is very difficult. It's hard to know what the right target price is for a company. And the underwriter, one of the things that they do is they do their best to help properly price the offering so that the company can get as much capital for the shares that they're selling. But it's difficult to price an IPO because there isn't a current market price available for that company. It hasn't been sold before. And so it's hard to see what the market would feel is a fair price. Private companies tend to have more asymmetric information. That means that the insiders of the company know a lot about the company, but people outside of the company don't know a lot. And that's different than companies that are already publicly traded. They have certain reporting requirements. If you're publicly traded, you have to report on certain things. As a private company, you don't. And so there's a lot more information out there about publicly traded companies, but for private companies, there aren't. So the underwriters want to ensure that on average, their clients earn a good return on their IPO. Underpricing, however, causes the issuer to leave money on the table. In other words, they sold their stock at too low a price. So let's just take a quick look. This is historical returns. This is the average initial return by month for IPOs. And this goes back to 1960 up through 2015. So you can see there are a lot more returns that are above the line and very few that are below the line. What does that tell us? That tells us that the stocks were priced below what the market felt they were worth. And so you can see that on average, the stocks tend to be underpriced, which if you're the one selling your stock for your company to try and raise funds, you don't want that to happen. You don't want to leave any money on the table. You want to sell it for exactly what it's worth and not a penny less. Here are the number of offerings by month for IPOs. So this just shows kind of a trend. There are waves of IPOs, and we're able to see, like for instance, at the end of 2000, we had a whole lot of IPOs coming out, and so there's different trends. This just means that the companies are trying to raise capital during these periods of time. Okay, let's talk a little bit more about new equity issues and price. So the stock prices tend to decline when new equity is issued. So this is talking about an existing company that's already publicly traded and they need additional capital. Well, this sends a message to the market. If they issue new shares, it tends to affect the current share price when new equity is issued. The possible explanation for this is there's signaling and managerial information in this. So signaling and debt usage, issue costs, all of those things have to do with the fact that new equity prices tend to go down. So the signaling and managerial information has to do with the management. It signals that maybe the management hasn't managed the funds adequately or appropriately. Signaling and debt usage, it also means potentially that it signals that they've used up all of their debt capacity. So they borrowed as much as they can borrow from banks. Now they need to go out and issue new equity. And there are significant costs related to issuing new stock, a lot of transaction costs and other things. And so it's generally looked on in the markets as a negative thing for the value of the equity. Since the drop in price can be significant, and much of the drop may be attributable to negative signals, it's important for management to understand the signals that are being sent and try to reduce the effects whenever possible. So we talked about issuance cost as being one of the problems and one of the reasons why it affects share price when we issue new stock as an already publicly traded company. There's several costs we'll go through. The spread we've already talked about. That's the amount the underwriter gets. Other direct expenses such as legal fees, filing fees. We're talking hundreds, if not millions of dollars in fees, depending on the size of the issuance. Indirect expenses, opportunity costs, such as management spending time working on issuing new equity. They could be doing something else. Abnormal returns, there's an abnormal price drop on the existing stock when new issues come out, so it affects current shareholders. Potential underpricing, this is in relation to IPOs typically, where they'll issue at below what really should be the market price. And then the green shoe option, which we talked about, and that could cost the company additional shares that the syndicate picks up if they're able to successfully fill the equity issue. A couple of other concepts to look at are rights offerings. So a rights offering is an issue of common stock offered to existing shareholders. So an existing shareholder has the right to buy additional shares of stock when they're being offered. It allows current shareholders to avoid dilution that can occur with a new stock issue. So dilution, I think of it like lemonade. You can have some really strong, powerful lemonade, and what you need to do to make it less strong, you just pour in some water. It makes it less strong. What happens is if I'm an existing shareholder and then the company sells a whole bunch of new shares and I don't buy any of them, then my percentage ownership is diluted. It's not as strong. And so a rights issue gives me first right of refusal. I have the right to buy a certain number of shares to keep the same percentage ownership in the company. So rights are typically given to the shareholders. They specify the number of shares that can be purchased. They specify the purchase price and the time frame. And rights can be traded over the counter. OTC stands for over the counter, or on an exchange. So like NASDAQ or the New York Stock Exchange. Rights have a value in and of themselves. So how do we value a right? And there's practice problems on this in valuing a right. The price specified in a right offering is generally less than the current market price. So there's an advantage for current shareholders because they're typically able to get it for a little bit less than what the current market price is. The share price will adjust based on the number of new shares issued. And so the existing share price will change as new shares are issued. So the value of the right is the difference between the old share price and the new share price. Okay, so now we're going to look at an example of a rights offering. Now let's suppose a company wants to raise $10 million. So they're trying to find $10 million. The subscription price for the rights is $20. And the current stock price is $25. The firm currently has 5 million shares outstanding. So the question is how many shares must be issued? How many rights will it take to purchase one share? And what is the value of those rights? So let's look at the answers. So shares issued, we calculate this by taking the total amount we're trying to raise divided by the subscription price. So we're trying to raise $10 million divided by 20 gives us 500,000 new shares that will be issued. The rights to buy one share, they're currently, prior to the new shares being issued, there are currently 5 million shares outstanding. So how many rights to buy one share? We take the 5 million shares divided by the new shares that will be issued. So the old amount divided by the new amount. So that means we need to have 10 rights to buy one share. So if I'm a shareholder and I own 20 shares, then I can buy 2 new shares in this rights offering. So our total investment is 10 times the 25 plus the 20. So the 10 are our new shares. This 10 are the number of, rights to buy one share. We multiply it by 25, which is the current market price, and we add in the subscription price, which gives us a total investment of $270. So our per share price is 270 divided by 11. Where did we get 11? Well, we needed 10, and then with 10 shares or 10 rights, we can get one share. So with each share that we own, we have a right. So we need to own at least 10 shares in order to get one, buy one more share. So there's our 11 shares. So 270 divided by 11 shares equals $24.55 per share. So the value of the right is the current market price minus the per share price to us if we exercise. So the value is 45 cents per right. So to buy 10 rights, it would be 45 cents times 10. So it equals $4.50 plus the $20 subscription price. So $24.50 per share. And there's a difference between these two because of rounding, but more or less they are the same. So rights in and of themselves have a value, and they can be purchased or sold on the open market. Let's talk a little bit more about dilution. Dilution is a loss in value for existing shareholders. And what it means is that their percentage ownership decreases. As new shares are sold to the general public without a rights offering, existing shareholders' percentage ownership is diluted. They have less percentage ownership. The market value, the firm accepts negative NPV projects. That's another way to dilute. If the firm does projects that destroy value, it dilutes our value. Then we can look at it from a book value and earnings per share perspective. This occurs when the market to book value is less than 1. That means the market value is less than what the book value is of the assets of the company. Okay, next, let's look at types of long-term debt. Companies can, in addition to issuing equity, they can borrow money. And they can do this in the form of loans, lines of credit, or issuing bonds. So bonds are a public issue of long-term debt. When a company sells a bond, let's say it's a $1,000 bond, what they're really doing is they're giving the buyer of that bond an IOU. And so the company has to pay that money back to the investor who bought the bond. So also there are private issues of debt where maybe they will borrow money from a large investor who has a large amount of money. Those could be term loans, direct business loans from commercial banks or insurance companies. And these are typically a little bit more short term, between 1 and 5 years, or intermediate term. And they're typically repayable any time during the life of the loan. Then there are private placements. Private placements are similar to term loans, but they typically have longer maturities. And these private issues or private debt, it's easier to renegotiate than the public debt. Public debt, there's a very strict contract, and it would be very difficult. Let's say you had 1 million different investors buy a million bonds that you issued at $1,000 each. You'd have to go out and negotiate with each individual bondholder. Whereas with private placements or term loans, it's one large chunk of money, one lender, and you can negotiate easier. Also, they're typically lower in cost than public issues because there's a lot less paperwork and reporting that needs to happen. The next concept is shelf registration. This permits a corporation to register a large issue with the SEC and sell it in small portions over a 2-year period. And so they tell the SEC, hey, we plan on selling this much, but we're going to take our time to sell it. It's going to happen over, say, a 2-year period. It reduces the flotation cost of registration, and it allows the company more flexibility to raise money quickly. So maybe they don't need it all up front. Maybe they don't want to be paying interest or a dividend to shareholders, and maybe they'll just want to raise, issue either new stock or those bonds as needed rather than all in at once. So some of the requirements of the shelf registration: the company must be rated investment grade. So there are rating agencies like S&P or Moody's, which will give them a rating such as AAA or BBB. So they have to have an investment grade rating. They cannot have defaulted on debt within the last 3 years. Default means they quit paying on their debt. So they had to have been current on all their payments over the last 3 years. The market value of stock must be greater than 150 million, so they have to be large companies, and they cannot have violated the Securities Act of 1934 in the last 3 years. So if they meet all those requirements, then they have the right, or the ability, I should say, to petition the SEC to allow them to do a shelf registration. With that, that was the last slide we were going to go through in this PowerPoint. I encourage you to do the quiz on your own. Read through those, see if you can answer the questions. If you have a hard time answering the questions, go to your book, try and find the answers, or re-listen to this PowerPoint presentation. Also, I encourage you to look at the ethics issue and think about that. And then there's a practice problem that you can look at. Please let me know if you have any questions. I appreciate your time.